In the spring of 2020, the world stopped. Fear gripped the markets. The global economy was staring into an abyss, and then the money came. Trillions of dollars unleashed by governments around the world in the single largest economic intervention in human history. It was called relief, a lifeline. It was meant to save us. But what if in the process of saving the economy, it fundamentally broke it? This is the story of the Great Money Glitch.
To understand the glitch, we first need to understand the machine. What is economic stimulus? The core idea comes from economist John Maynard Keynes. He argued that economies don't always fix themselves. When fear takes over and everyone stops spending, a situation he called a failure of animal spirits, the system can get stuck in a downward spiral. His solution? The government has to step in and become the spender of last resort. Think of the government and the central bank as having two different pedals to get this car moving again. The first is fiscal policy. This is the government itself. They can cut your taxes, leaving more money in your pocket to hopefully spend, or they can spend directly, building roads, funding green energy projects, or sending out checks and unemployment benefits. The theory is that this creates a multiplier effect. Every dollar the government spends gets spent again by someone else, creating a ripple of economic activity that's bigger than the initial investment. The second pedal is monetary policy. This is the domain of the central bank, like the Federal Reserve in the US or the European Central Bank. Their main tool is lowering interest rates. This makes it cheaper for you to get a mortgage or a car loan, and cheaper for businesses to borrow and invest. But what happens when interest rates are already at zero? This is called a liquidity trap. At that point, they pull out the superweapon, quantitative easing, or QE.
This idea of government intervention isn't new, but the scale and our reliance on it have exploded. During the Great Depression, FDR's New Deal was a radical, massive government response to economic collapse. Through the latter half of the 20th century, we saw smaller, targeted stimulus packages for various recessions. But the real paradigm shift, the moment the machine was supercharged, was the 2008 global financial crisis. Suddenly, hundreds of billions wasn't enough. For the first time, quantitative easing went from an obscure theory to a multi-trillion-dollar reality. Central banks across the globe, in a then unprecedented move, coordinated to inject $2.5 trillion into the system in late 2008 alone. China launched a $500 billion plan. Europe, Japan, everyone hit the panic button.
If 2008 set a new precedent, 2020 shattered it. When COVID-19 shut down the world, policymakers looked at the 2008 playbook and decided it wasn't nearly big enough. They didn't just bring a gun to a knife fight. They brought a weapon of mass economic construction. The numbers are almost incomprehensible. By May 2020, global fiscal support hit $9 trillion. That's $9,000 billion. In the U.S., the CARES Act alone was $2.2 trillion. This included direct payments, the Paycheck Protection Program to keep businesses from laying off workers, and hugely expanded unemployment benefits. In total, over $814 billion was sent directly to American households. And the central banks? The U.S. Federal Reserve more than doubled its balance sheet in under 2 years, buying an additional $4.4 trillion in assets. It was a philosophy of whatever it takes on a scale that rewrote economic history.
This unprecedented flood of money achieved its goal. It averted a second Great Depression. It was a powerful fix, but powerful medicines have powerful side effects. This massive intervention created a systemic expectation that the government will always be there to bail us out. It created what we're calling the great money glitch. And the first, most painful symptom of that glitch is something we've all felt in our daily lives, in our bank accounts, at the checkout counter. In our next video, we'll investigate the immediate consequence of this monetary flood, the inflation bomb.